talk about some of the stuff we got going on, including the Fed and what's going on with them. We're going to talk about how stocks are reacting, what is going on with Trump in the White House. Also, while preparing this video, I got some more updates on the US getting more involved with the Iran versus Israel war, so we'll talk about that. Hope you enjoy this video, and as always, you're welcome to come hang out with me while we learn what's going on. So, just to kind of start off and kind of backtrace, we heard a lot from the Fed this prior week, and I just kind of wanted to touch base and see where we're really at. So we got this monetary report for June 2025, and one of the main takeaways a lot of people in the market took away from this is this last couple sentences of this first paragraph right here for the summary. So look at this. It says, however, actually, let's just read the whole thing. We got time today. Inflation has continued to moderate this year, though it remains somewhat elevated. The labor market is in solid shape with a moderate pace of job gains so far this year and the unemployment rate at a low level. Trending up though. Although growth in real gross domestic product, referring to GDP, is reported to have paused in the first quarter, growth in private domestic final demand was moderate, reflecting a modest increase in consumer spending and a jump in capital spending. However, and this is a big however, actually, they should capitalize this however. However, measures of household and business sentiment have declined this year amid concerns about the effects of higher tariffs on inflation and unemployment, as well as heightened uncertainty about the economic outlook. So what the Fed's really saying right here is that they're forecasting weaker economic growth, mainly due to two things. And they didn't necessarily say these two things. They're just kind of saying one, the T word, not Trump, tariffs. But the other one is interest rates. And think about these two things. They don't hit and immediately impact the market. They take time to actually kick in. So with these taking a while to work themselves through the economy, when they do finally increase these costs, it does a few different things, and I wanted to look at these from different angles. Here, let me organize myself. We got a lot to cover today. So let's look at these from a few different angles. The first is more from your consumer demand side. Increasing costs allow people to buy less and hold off on purchasing. So they're going to kick the can down the road. I rather just save my money right now. I'm not going to go buy that new bed or that new car or go buy a house or new appliances, whatever the big purchase is. Tariffs and interest rates are impacting it. And then this second angle we're going to look at is more so from the point of view of inflation, and this is kind of what the Fed's more so tunnel visioned on is inflation. They said they don't really care about the job market, it's what inflation is doing. And inflation has been cooling. The last few reports we've gotten have showed, but these increasing costs show up in the data as higher inflation, mainly due to these tariffs, which are expected to increase the rate of inflation, because tariffs increase cost of goods. We got some crazy high tariff percentages, and those are expected to, at one point or another, finally kick in and show up in the inflation reports, causing a surge in inflation. So what we got is weaker spending from both consumers and businesses. High financing costs due to these high interest rates. The first one was due to the tariffs. Well, I guess weaker spending comes from both tariffs and high financing costs, but then they still got the high financing costs. And then there's this expectation that jobs will be impacted at some point. So just to kind of back up a little bit and rewind, what we had during COVID was this period in time where there were supply shocks, there were labor shocks, and we really never seen anything like it. But this put businesses in a spot of not being able to get enough help. Like, imagine that. Like, people want so much of my goods and services that I just don't have enough help to serve these customers and clients that we have. So they couldn't get as much help as far as workers go. Now let's fast forward to where we're at now here in the present, and employers aren't necessarily laying off a ton of people, and we got a big but here. But they really aren't hiring yet either. So they kind of held on to, after that sour taste in their mouth from COVID and not having enough workers and all that, they kind of held on just in case with the hope. But it's getting to the point to where, all right, well, we don't really want to lay these people off, but like, as they like get fired or quit, move jobs or whatever, we might just sit tight. We might not necessarily hire for a new role yet. We're going to wait and see, just like the Fed and just like these consumers who don't want to purchase anything right now. We're just going to wait and see what happens. So what we got are people with jobs feeling okay. They feel fine. They got money coming in. But it's these people without jobs that are having a real tough time finding a job. And who are a big group of people who are looking for jobs? College graduates. And although the Fed finds that the labor market's doing pretty well, we don't see any concerns, the unemployment rate's at low levels, although it's starting to trend up, we don't see anything wrong with the labor market yet. But if you look at it from just college graduates, I believe their unemployment rate's closer to, forget the 4%, that's closer to like 7%. So when do these red flags and alarms start going off, kind of alarming or bringing attention to this other data that's just kind of being, just turning the nose to and forgotten about or looked past? So let's look at where jobless claims are right now. So we got that jobless claims last week that we did cover, and we're not going to go into this too deeply. Initial claims was at 245,000, a decrease of 5,000. The previous week's level was revised up. I'm interested to see what this week is going to look like, but I digress. So this is the part that I wanted to point out. The 4-week moving average of 245,500, an increase of 4,750 from the previous week's revised average. This is the highest level for this average since August 19th of 2023, when it was 246,000, which we're not too far off from that. And then here's another one to, just pay attention to, right? The advanced number for seasonally adjusted insured unemployment during the week ending June 7th was 1,945,000. It did decrease a little bit, but this number is huge. And this is the highest level for this average since November 20th of 2021, when it was just 2,004,250. That's a lot of unemployed people collecting insurance benefits. And who's paying for that? And this comes just as companies aren't necessarily laying off a ton. I brought this tech layoff tracker up, and I mean, it's not crazy. I mean, May we seen a lot of layoffs, 24, almost 25,000 people. But I mean, this year hasn't been too wild as far as layoffs. But there are starting to come rumors that are being surfaced of companies planning on laying off. We got Amazon, we got Apple, Microsoft just announced they were going to lay off 1,000 people. Procter and Gamble, Estee Lauder, there was a few others and I just can't remember their names. But although like layoffs aren't crazy right now, and I've never used this website before. Here, what's it say? So far in 2025, there have been 368 layoffs at tech companies, with 83,960 people impacted, about 488 people per day. Oh, wow. In 2024, there were 1,115 layoffs at tech companies, with 238,461 people impacted, about 653 people per day. We're about halfway through the year, and actually, I think we're past that mark now. So assuming that we're just stay on track and nothing gets worse, we're not going to reach the levels of last year according to this layoff tracker, but there are companies starting to announce layoffs coming soon. Now, back to the Fed, we wanted to kind of wrap this one up. So I believe it was page 60 I was going to talk about, where it presents the dot plot. Yeah, here we go. Here's the dot plot. And what we see is the Fed's dot plot shows that they're forecasting still 2 cuts this year, right in line with what the market's expectations were for rate cuts. You know, they want more, but they were really expecting us to get 2. And this is out of the 19. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 of the 19. Let's double check. 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. All right. And that is for 2025. So yeah, they're forecasting 2 rate cuts still. They're still standing ground on their wait and see approach. They want more data to come in and requiring more data to come in before they make any further actions outside of any expectations they're setting the ground for right now. And Trump is kind of in the middle of this, right? Because he makes everyone aware of how he's feeling, what he's saying. And really what he's been saying, and we cover this all the time, is he's been bashing and trolling the Fed. So recently he said the Fed's wait and see is costing our country hundreds of billions of dollars, really referring to the interest the government pays on its debt. Then he also has attacked Powell a few times. I mean, man, maybe even a dozen times, saying that Powell, one of the dumbest and most destructive people in government and the Fed board, is complicit. Let's look up that word real quick, just to make sure we're on the right track. Involved with others in an illegal activity or wrongdoing. Ah, man, this is comedy. This is comedy. It's literally like a reality TV show out here. Watching all of this mess just go on all the time. And man, it just doesn't stop. And I'd imagine it's not going to stop. We also got, and I'd imagine this is why Trump is so zeroed in on the Fed cutting rates. Mainly just because he has his one big beautiful bill that's expected to pass July 4th. And what it's going to do is increase the national deficit, increase national debt by about 3 trillion over the next decade. And the interest expense is an obvious concern for Trump, because while he's trying to make America great again, increasing the deficit increases the amount of interest that has to be paid while interest rates are high. So that goes back to the Fed and what they're going to do. So I wanted to look at what these interest rates are. These interest expenses are looking like. So interest expense is the interest the government pays on its outstanding loans through treasury securities. It can be referred to as the cost to the U.S. for borrowing money. Yada, yada, yada. All right. So for all right, let's look at 2024. And y'all see this little, let's make sure y'all can see the little white line. So yeah, y'all could see the little white line. All right. What does that stand for? The average interest rate. Okay, that makes sense. So for the entire year of 2024, the fiscal year of 2024, the interest expense for the government, the national debt, was $1.13 trillion. And I believe rates are a bit... yeah, they did. Last year was a mess. So far, we're only up to 776 billion in the interest expense, but the year's not over with. We'll see how we really match off to this. Is that what they're forecasting? Bars in the chart with a solid fill represent completed fiscal years. The bar with the diagonal lines represents the current fiscal year to date. All right, so year to date. So we're halfway through and we're already up to $776 billion in interest expenses. And we're expecting to, assuming everything's cool, calm, collective, and the bill gets passed, the big beautiful bill is expected to increase government spending and increase the national deficit. So we'll be watching this. The interest expense on government debt and the US borrowing money is for sure a big topic, and we have this US debt clock right here that I wanted to look at real quick. And there's a lot of moving pieces right here, but let's pay attention to US national debt, which is at, that's 100,000 million billion trillion. So 37 trillion. 37 trillion in national debt. Then it got to the per citizen, about 100,000, 108,000 per citizen. Get out of debt, y'all. And then we got the US federal spending, which this one's going to increase, assuming the big, beautiful bill passes how it is right now. Right now it is 100,000 million billion trillion, 7 trillion, 7.1, 7.2 trillion. Now, here's the one we're paying attention to. The US federal budget deficit. So when the US spends money and they don't bring it all in from taxes and now tariffs and stuff, they got to issue treasuries as like an IOU, like, hey, give us your money, we'll pay you back eventually plus interest. But that's what the government has to do to pay the rest of the bills, right? And right now that is at $2 trillion. And with interest rates being a thing, like you pay interest on money that's borrowed and them being kind of high, like yields are pretty high, and yields for these longer term treasuries follow the inflation expectations. Let's see what CNBC is showing the yields are. Let's look at the 10-year treasury yield. Just really quickly. I promise it pertains to the subject. All right. So the 10-year treasury yield is at 4.37%. What about the 30-year? That's 30. Dang near 5%, y'all. Look at that. 4.89%. So when treasuries follow inflation expectations, it's not necessarily what the Fed's doing. Rather, the Fed reacts to all of this. They react to economic data and what the economy is doing. They don't necessarily drive the boat, though. So back to the national debt. When there's this budget deficit, they have to issue money, issue treasuries. And these treasuries, like these 30-year treasury yields, they're paying 4.89%, almost 5% risk-free, directly from the US Treasury, from the government. So it makes sense why Trump wants these interest rates much lower and why he keeps trolling the Fed. He could probably go about it a different way, but I'd imagine that's just kind of his character, and that's just who he is under the spotlight. And there's probably more that's going into it than I'm covering in this video, but we're just chilling on a Saturday, y'all. Now, the big beautiful bill, let's talk about that, because that is expected to reduce taxes. It's expected to increase government spending, generate tariff revenue, and the main two are the last two that I just mentioned: increasing government spending and generating tariff revenue. So tariffs, those two things increase inflation. They create inflation. So in the face of the Fed already forecasting pretty much stagflation and a stagflationary environment down the road, right around the corner, there's a lot of uncertainty about where the economy is headed. In the long term, I think everything's going to be just fine in the long term. Somehow I got that hope. But in the short term, no idea. I don't know where we're going to go, where we could possibly end up. Stock market crash, asset values crashing, wide layoffs, or a big, deep, dirty recession. I don't know where we're heading. But for stocks, let's talk about stocks and how they are doing. So in the short term, we don't know what's going on, and neither do market participants. So there's this I don't know that's making people iffy on whether or not they should continue buying these stocks. We're on the 30-minute charts, and you can see for the S&P 500, it's been pretty, since the 17th, just kind of like bobbing around in these ranges. Same with the Dow, same with the NASDAQ, although the moves get a little bit larger. There's a little bit more volatility. Same with Bitcoin. Like, they've all kind of consolidated, but kind of in like a down way. Like, for sure, you could see a higher high and then a lower high, and then a lower high. And then it just keeps on happening. So people are suspicious about whether or not stocks are a good buy or not. Let's put these on the day charts. And you can see we're not too far away from our all-time highs on these charts. I mean, the Dow is kind of far away. Bitcoin's not too far away, within thousands of dollars. Pretty much, to sum it up, all of the stocks are near all-time highs. Bitcoin's near an all-time high. And it's understandable to be sketched out as to whether or not this is sustainable and if we're going to reach new all-time highs and keep going, or if we're starting another downtrend like what we've seen from pretty much February 20th all the way until April like 8th or 9th, April 10th about. Before we really bought the dip and continued enjoying a nice little rally. Now, we don't know where we're going to go. There's a lot of risks, though, and that's why it's understandable to be a little iffy on the stock market. And some of these risks include the economic risks. So, can we go into a recession? That would impact all of these companies through company earnings, people not spending as much, companies' investments slowing down. So, the entire economy is at risk. And then political risk, what is in the pot being stirred by the man in the White House right now, mainly along the lines of these tariffs and trade deals he's working on. And then back to the earnings with companies. In the midst of it all, these earnings expectations for these companies, for the S&P 500, I believe the forward PE or the PE ratio is at like 22, and that's super expensive. And when you consider all of this stuff going on, like like sketch short term, that's sketch, right? Like, yeah, we could pull up the all-time chart on all of these. Let's just pull it up on the quarter. Yeah, straight up. But just in the short term, kind of sketch, y'all. It's just kind of sketch, and all of that's understandable. Now, there is some hope that everybody's kind of placing on, like, as a something that could kind of save us, and it's AI. Ironically, right? And when you think about it, AI is where people's placing their hopes for these companies' earnings, just because it allows people to do more work. So less people can be more productive, even with less earnings for all of these companies. Remember, Bitcoin's not a stock or a company. It's decentralized finance, digital gold. But as far as this chart, and this chart, these stock indices, it allows companies to save money because now they don't necessarily have to. Let's imagine this. You got a group of 7 people running your building. All right, well, maybe instead of 7 people, 3 people could run it, be more efficient than the 7 people running. They save money on those other 4 wages and salaries they were paying, and they're more profitable because they're able to do more with AI. So a lot of people are hoping that cost cutting due to AI can possibly help just help. Let's just leave it there. And we don't know if that will be the case or not, but that's just a hope. But I mean, it all goes back to the labor market concerns that we're having, because in the longer term, AI is expected to take more jobs away from the labor market. And those are some concerns that have to be considered in the longer view. But in the short term, like I said, we don't know what could necessarily happen. We're still pretty early to the AI revolution that we're going through, and many are making predictions that UBI, Universal Basic Income, is right around the corner. But there are changes that spark changes, and we just go through these cycles, and there we are. So the current cycle we're going through right now, where we're at, and this is in order to current. So number 3 will be most current, and number 1 will be kind of like the first concern we had. So the first concern that was really brought up since after the pandemic was the Fed, inflation, and interest rates. So inflation went pretty crazy due to the Fed lowering interest rates back during COVID. During the pandemic, they had to stimulate the economy. People stopped spending money, and that was a very that could have got very dangerous. So, due to skyrocketing inflation, the Fed had to then raise rates, and we're just kind of now getting out of that cycle to where they've been lowering rates a little bit. By rates, I mean the federal funds rate, and that impacts like the front end of the curve, and inflation expectations impact the back end of the curve. So, those treasury rates we were just looking at, the 10-year, 30-year treasuries, which mortgage rates follow the 10-year treasury yields. Um, that's more so dependent on what inflation expectations are looking like, and we just talked about all of the factors impacting inflation expectations. In the front of the curve, which the Fed does control, the federal funds rate, that impacts like overnight borrowing costs from bank to bank, credit cards, like stuff that doesn't even like it matters, but in the grand scheme of things, credit cards aren't as important as and the rates are much higher than a 30-year mortgage, so to say. So number one was the Fed, the fight on inflation, and the federal funds rate as to where interest rates are right now. Then two came up. Trump got elected, and that man came out and issued all of these tariffs on Liberation Day. They were a lot worse than people were expecting, and now it's just kind of been down to Trump trade, tariffs, and deals. What's going on with all of that? And then something else took the spotlight just to stack on. It's like a nice little cake. So we got the Fed, we got Trump, and then we got the Iran versus Israel war. And that's where we're at. And we talked the Fed and the inflation. Trump is supposedly getting great deals organized. We don't know if that's the case or not. Said he's working closely with Harvard and possibly a deal can be announced next week. Cool, I guess. The US and the EU are near a deal, but it's a non-tariff related deal. So it's interesting where we're at with this, because we've got all eyes on, well, all eyes were on Trump, and then it's like there's this new shiny object that's out distracting everybody. But if they were still all on Trump, doesn't seem like his Trump tariff trade deals are going too well, as far as, oh, we're gonna have so many deals, so many deals. That doesn't seem to be the case right now, because all of the good news that we're getting are non-tariff related with Harvard, and I guess the Harvard, working closely with Harvard and exchange students and stuff, that's kind of good as far as China, but there's nothing on the US and China deal either. We haven't heard from that in a minute. So now on the Iran and Israel war going on with all of that mess, it seems like it's still at it. I believe today is day number 9. And it's escalating, but it's not like super severely escalating. And there are some reasons why. So I got this piece, and everybody's eyes are on oil, watching oil prices, because that is another inflationary factor. And we just talked about inflation, the Fed's fight on inflation, what inflation expectations impact, which would be the back end of the treasury curve, which impacts borrowing costs for buying a house, so to say. So just to kind of sum it up in like 30 seconds. Now, this piece right here, why hasn't Israel attacked Iran's oil exports? Restraint is a threat, by Skip York. And what they go through talking about is, here, I might have lost my piece. First and foremost, both Israel and Iran appear to be acutely aware that a miscalculation could rapidly spiral into a broader regional war. Dang, I couldn't even couldn't speak correctly. One of the consequences neither side can fully control. Israel, while assertive in protecting its national security interests and limiting Iran's regional influence, remains cautious about provoking a multinational conflict. Iran, meanwhile, seeks to balance its ideological posturing and regional ambitions with the need to avoid direct confrontation with a more technologically advanced adversary. So pretty much what it goes on to say is, for Iran, for Israel, I'm mistaken. So for Israel, maintaining the support of the US and its European allies is essential not only for military assistance, but also for its diplomatic cover. Escalating a conflict in a way that disrupts global oil flows could erode that support. Iran, on the other hand, is attempting to expand its energy partnerships in Asia and sustain trade routes with China and India. Remember, Iran is a cheap plug for oil for China. Provoking an oil price surge or triggering new sanctions by attacking energy infrastructure would risk isolating Iran further at a time when it can least afford it economically. Because Iran, that's its thing, oil, right? And petroleum and energy. So we see that these countries are kind of like bickering at each other, but it's not like a fist fight yet. Like, yeah, they're shooting missiles, yeah, it's like bad, but it's not what it could be. So they're not escalating it, but don't worry, somebody is. We got the US escalating it. So today we got live updates, and this is what I seen while I was working on my video, like preparing this video that we're doing. US begins moving B-2 bombers as Trump weighs attack on Iran. The move signals the US is getting the bombers in place if they are needed for a strike on Iran, but officials said there had been no order for a given attack. The Pentagon is moving stealthy B-2 bombers over the Pacific from the Air Force Base in Missouri, a sign the Trump administration is getting them in place if needed for a strike on Iran. They can carry a bunker buster, which this bunker buster BOMB. I don't want to say it and then get like delisted or anything. The 30,000-pound conventional weapon that defense analysts say has the best chance of damaging Iran's Fordow uranium enrichment facility. A lot of tongue twisters in today's video. President Trump continues to deliberate over whether to join Israel's military campaign against Iran and has said he would decide within 2 weeks. So it's back to the 2 weeks. A lot of people died. More people died. More people died. The war is still going on. Let's see if there's any later updates. It just kind of goes on to talk about how all this is working. So yeah, that kind of gets us up to date with the Iran versus Israel war. And kind of when I was reading this, it made me think, because yesterday we were talking about, well, y'all remember the taco trade was a thing. Remember, Trump always chickens out? And with him giving this deadline here, because it's not like this is the first deadline we've ever seen. Hey, I got 2 weeks to sort this out. I mean, we've seen that with China, with Europe, with all of these other countries, with TikTok, and it just keeps on getting like pushed back over time. So it makes people think like, oh, Trump's bluffing, he's all talk. So whenever there's these moves in the stock market, when Trump said, hey, like, if y'all don't do this, it could get worse, and that worse could impact stocks. But market participants took Trump's bluff and bought the dip because they didn't believe it would get worse. So I think him doing this is just to kind of get away from that taco trade, because he's well aware that people believe this about him. Like, he's been asked about it, and he's not very fond of having that reputation. So this just gives him negotiation leverage, like, hey, I got 2 weeks. Let's go, like, park some jets over there that can do some damage, but we're not gonna use them right now. We're just gonna like park them at the Walmart and leave them there, and hey, put the little ticking time clock over it, or the Batman what's it called, the Batman emblem in the sky, but of the ticking 2 week time. And let's go from there. And this might drive some urgency and really make people think that Trump is about his talk. So y'all, that's what we got today. Let's look. We talked about it yesterday, but man, we've all slept since then. So let's look at the economic calendar and see what we got tomorrow to look at. So once we load, we find out that we got PMI for services and manufacturing data coming out on Monday, existing home sales. I mean, this is important data for sure, but it's not like the highlight this day. On Tuesday, we got Case-Shiller Home Price Index. This is going to kind of tell us how 20 cities' home prices are doing. We got Beth Hammack, a Fed president for Cleveland. They'll be speaking consumer confidence data. Fed Chair Powell testifies to House Financial Service Committee. Yeah, that's cool. Tuesday, though, I mean, if anything, everybody's going to be watching Chair Powell, but, I mean, I'd imagine we're not going to get too much. Wednesday, new home sales. I'm a real estate agent. This is an interesting time for selling homes and buying homes with everything. Literally, the mess of the mess is going on. But I'm going to say, as far as economic macro news and data that's relevant to move markets, I'm going to say Wednesday is not an important day either. So it really comes down to Thursday. We get the trade balance in goods, retail inventories, wholesale inventories, jobless claims. A lot of people are watching the labor market, including the Fed, even if they say they're not watching it. Because if that unemployment rate ticks up, yeah, they're watching inflation, but they're watching that unemployment rate and how jobs are doing. Durable goods, GDP. Oh wow, the Cleveland Fed President Beth Hammock speaks again. So they speak Tuesday and Thursday, pending home sales. So Thursday, it's starting to wind up a little bit, and then Friday is the banger. Mark your calendar for Friday, June 27th. We got consumer sentiment, personal income, personal spending, PCE. This is the one. This is the Fed's preferred measure to measure what inflation is doing. Remember, we're expecting it to tick up, and you can see that here in the expectation. So for core PCE year over year, last month it was at 2.5%. This next reading on Friday is expected to come in for last month at 2.6%. So up just 0.1. Now, if we land exactly where we're expected, or if we come in soft or high, I'd say that doesn't really move the needle, so to say, as far as what the Fed's going to say or expect, or what the market expects them to do. But it's when it comes in like excessively high or way low is where it will really impact the Fed and their current wait and see approach. So July, we looked at the CME Fed Watch tool yesterday. It looks like it gave back a little bit. So yeah, we're still on track for a no cut on July 30th's meeting. September 17th, I sound like a broken record player I feel like a broken record player every time I say it, but that is when we're expecting our first cut. And it looks like that give back from the July 30th we've gotten went to September 17th, because this surged a bit over 60% up to 64.7%. And what this 64.7% represents are the odds that the Fed cuts by 0.25% or 25 basis points on the 17th of September's FOMC interest rate decision. So that's what we got for this weekend, y'all. Whole lot of stuff I didn't even plan on doing a video, and we're up to almost 40 minutes on today's video. I love you if you stuck around with me and like hanging out. I always invite you back. Hope your weekend's great. Hope your day's a blast. I got a birthday party to get to. I told him it would be an hour, and here we go. Here we are on like an hour and a half going on 2 hours. But I love y'all, man. Thanks for hanging out with me, and you have a blast.